Ladies and gentlemen, good day and welcome to the Mankind Pharma Q4 FY23 earnings conference call hosted by Kotak Institutional Equities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Alankar Garude from Kotak Institutional Equities. Thank you, and over to you, Alankar.
Good morning and good afternoon, everyone. On behalf of Kotak Institutional Equities, I would like to welcome you all to the fourth quarter FY23 earnings conference call of Mankind Pharma. I would now like to hand over the call to Mr. Ravi Agarwal, Head of Investor Relations, who will introduce the senior management and take the discussion forward. Over to you, Ravi.
Yeah, thank you, Alankar. Good afternoon, everybody. I'm Ravi Agarwal, Head of Investor Relations at Mankind Pharma. I thank you again for being with us today on our Q4 and 12 month FY23 earnings conference call. On the call today, we have Mr. Rajeev Juneja, Vice Chairman and Managing Director, Mr. Sheetal Arora, CEO and Whole-Time Director, Mr. Arjun Juneja, Chief Operating Officer, Dr. Sanjay Kaul, Senior President, Sales and Marketing, and Mr. Ashutosh Dhawan, Chief Financial Officer. We'll begin with opening comments from Mr. Juneja, providing an overview to the quarter and full year performance. This will be followed by comments from Dr. Kaul on the business performance, followed by Mr. Ashutosh, who will share some key thoughts on the financial aspects of our performance. There will be an opportunity at the end of the opening remarks to get your queries addressed by the management. Before we commence the call today, I would like to remind you that some of the statements made on the call today could be forward-looking in nature, and a detailed disclaimer in this regard has been included in the press release that has been shared on our website. I now invite Mr. Juneja to share his comments.
Thank you, Ravi, and good afternoon, everybody. This is super pleasure to provide you our first results update post-IPO to our value investors today. I may have met some of you before the IPO, all of us, but there must be some with whom I did not have any chance of interacting earlier. So I welcome you today. And before I start this written commentary, let me speak something from the hard side, from my hard side, that we always mentioned that what basically is the aspiration of mankind. Mankind's aspiration is to become the most admired institution in India. That's the inspiration, and we have always followed our heart and gut, whichever path we have ever taken. Mankind is a very, very unique company. It is actually a consumer health company. And why I say so? Because we are not depending upon few thousand doctors. We are covering 4 lakh doctors. And we have always believed one thing, that don't follow certain companies, don't idolize certain companies, rather disrupt the market. I give the examples, whether it was our bottom-up approach to start with, or gradual increase of our footprint in India from Meerut to Mumbai. If in Meerut we launched in 1995, in Mumbai we came 20 years back, in southern part of India, 22 years back. Whether it was only marketing for a few years, then coming to manufacturing, and then to R&D. And again in marketing, we are the only company, unique company, covering 4 lakh doctors. This is a very, very big scale. And if you look at the manufacturing side, 75% products are being manufactured in our own manufacturing facilities. And if you talk about, highlight about R&D, we have a distinction of inventing dydrogesterone. Not only that, in our OTC domain, consumer side only, look at our philosophy of always going for leadership position, whether it was Manforce condoms or Dragonese or Acne Star or Unwanted 72. It really tells our intentions that whatever we say, we walk the talk. And again, at different times, our philosophy has been different. There was a time we were just dependent upon waterborne diseases, and today it is airborne because air has become polluted. Once upon a time, our major products were antidiarrheal, and today it is respiratory products. There was a time in 2004, till 2004, we were depending only on acute side, and today in 2023, our share in chronic side is 34%. Whether it's diabetes, cardio, neuro, psychiatry, respiratory, and so on. We have a lot of chronic side lifestyle diseases drugs. That really tells one thing about Mankind, that we are a very, very dynamic company. And not only dynamic, at different times we are more differently. And how different are we? You'll be surprised to know that this is a unique company, Mankind, where there are no targets for our people, salespeople. This is only unheard of, because our belief is that everything happens in long-term intangible things. I mean, benefit lies, growth lies, solid foundation lies in long-term intangible things, which become very profitable, tangible things in time to come. And our belief is also there that we put our focus on people, processes, and products. So that creates a vibrant kind of atmosphere in the organization. The uniqueness of Mankind is when GST came, people were shrinking down, lowering their number of CNFs. We did not do it. We rather increased. So we have a distinction of having more than 15 CNFs. And our belief is that we are a company of only long-term. Our belief is anybody who believes in short-term kind of a thing, he loses focus on right kind of a karma and right kind of a process. Because our belief is that pharma is not a cyclical kind of a business. Healthcare is all about 24/7. Now, after post-COVID, it has become more prominent in people's mind. It is 365 days. And there was time our sale in first half used to come around 56%, and we used to depend only on acute side. But nowadays, because of our dependency on chronic is also increased, our share has increased. So it's quite stable. I mean, maybe it is 50% in 6 months, and the rest is in the rest of the 6 months. And what we believe actually, we believe that best quality can be given at the most affordable prices everywhere in India. We're totally India-centric company. Our belief is that we can do fantastic in India. That was a commentary from the hard side. Let me read out the things. What we see that pharma industry witnessed a normal year after 2 COVID years in 2023, which moderated the overall growth rate for the industry. With this context, I'm happy to share that the company has maintained its strong growth trajectory during the year. Our domestic business segment continued to outperform the IPM in 2023 with a growth of 11% year on year against IPM growth of 7.9% during the year. Within this, our cardio segment grew by 14% with a market share of with a share of 34% against 33% share last year in our total sales, domestic sales. We also successfully integrated Pharma acquisition, and during the year, EBITDA for the company was 1913 crore, 1913 crore rupees, with a margin of 21.9% during the year. Our margins were lower by 390 bps due to higher API cost, especially in first half of 23. Higher employee costs from the additional headcount from Pharma, and not to forget one-off, the cost from business integration of Pharma. We have taken various measures to improve our margins, and we are confident that we will be able to deliver our historical margin of around 24 to 26% in the medium term, while growing at 1.3x to 1.4x of IPM. For the quarter, our revenue grew by 19% year on year, with a EBITDA of rupees 419 crore rupees and a margin of 20.4%, representing a growth of 45% year on year. Before we get into specifics of the business, I would like to highlight the key strategic aspects of our segments. The strategic pillar on which our business are built, the first is the Mankind is a company primarily focused on India. With almost 97% our revenues are coming from India. This focus will not change as we believe that there are unbound opportunities for the growth in the country. Second, our core value proposition of affordability, accessibility, and the best quality will be central to our business going ahead to generate volume-led growth and prescriptions. Third, we see a clear chance of rising prevalence of chronic diseases in India, and we will aggressively focus on increasing our presence in chronic segments going ahead. This will be through expansion in our new therapies, growing presence in existing therapies. It will also be through increasing penetration in metro, especially within super specialty doctors, for which we have created a dedicated division. The strategy here is to garner dominant leadership position in identifying white spaces in key chronic therapies through in-house R&D, acquisitions, in licensed products, and through best in the industry doctors, stockists, and patient coverage. Fourth, we'll continue to aggressively invest in marketing to create and support our dominant brand leadership across our pharma and consumer business. Within our key Class 2 and Class 4 towns and rural market, we will be focusing on increasing the value of prescription, bringing more prescriptions from the same doctors. Our corporate brand Mankind, which creates synergy benefits across both pharma and consumer verticals. We have a very unique consumer healthcare business with a market leadership, and will aggressively continue to grow and expand this business through brand extension. Prescription to OTX to OTC, we have done plenty of, whether it's a Health OK, whether it's a Star. We have both. These are two examples where we shifted our prescription products to OTC side, OTX to OTC side. Going forward, also this the product we have acquired from Nimulid from Panacea will be shifted over there. Also, our record in creating brands has been very good, from around 29 brand families with the sales above 50 crore in year 2020. Today we have 37 brand families which are above rupees 50 crore. With 11 of them are above 200 crore rupees each. If you consider that, we are a company less than around 28 years old. We are a 28 years old company. We are probably one of the fastest, youngest company to create such a brand success in India. We hope we keep doing the same good work. Thank you so much. With this, I hand over to Concall, Senior President, Marketing. Cheers.
Thank you so much, sir, and good afternoon, ladies and gentlemen, and welcome to today's investor call. I would like to take this opportunity to provide you with an update on our domestic business with a specific focus on our consumer healthcare segment. Let's begin with our domestic business revenue, which reached rupees 8,453 crore in FY23, reflecting a year-on-year growth of 11%. Excluding the impact of COVID-19 pandemic, our revenue growth stood at 15% during the year. In Q4 FY23, our revenues amounted to rupees 1,972 crore, marking a robust year-on-year growth of 18%. According to IQVIA, our secondary sales growth for FY23 was 10.6%, outperforming the industry's 7.9% growth rate. This trend continued in Q4 FY23 with our secondary sales growth at 24% compared to the industry's 14.9%. It's worth noting that our long-term historical performance has consistently positioned us at around 1.3x to 1.4x the industry growth rate. Additionally, IQVIA reports that we maintained our market rank of 4, holding a market share of 4.4% during the year. However, when considering the CVM, our market share reaches 6.5%, securing the second position in India. Analyzing the price and volume metrics, we have been closely in line with IPM as far as price increase and new product growth contributions is concerned. Notably, our volume growth reached 2.6%, outperforming the flat volume growth of the IPM. This success is attributed to our expansive distribution network, large field force, and strong presence among doctors, making us one of the industry leaders. We firmly believe that volume-led growth reflects the superior quality of our sales, as it is driven by prescriptions and thus more sustainable. Another point to note is that we have consistently had the highest prescription share over the last 5 years. Even in FY23, our prescription share increased by 0.2% and stood at around 15.5%. We also have 2,200 crore plus brands, which is third highest in the industry. As Rajiv sir mentioned, a key aspect of our business strategy is expanding our presence in the chronic segment. We have witnessed steady progress in this area, with the chronic business accounting for 34% of our sales in FY23, up from 32% in FY20. Furthermore, in Q4 FY23, it increased to 35%. Notably, our chronic business achieved a growth rate of 14% in FY23, surpassing the IPM growth rate of 11%. In Q4 FY23, our chronic business growth stood at 25%, while the IPM growth rate was 15% only. This represents an outperformance of 1.3x and 1.7x respectively during the respective periods. We have a robust strategy in place to launch unique products, including those from in-licensing. We have started witnessing fantastic results from this initiative. For instance, our in-licensed product Neptaz, which is sacubitril valsartan for long-term heart failure, received an outstanding response and was ranked the second best new product launch in India for FY23 according to IQVIA. Now let's shift our focus to the company's overall PCPM. Despite a substantial increase in our field force during the last 3 years, the average PCPM of the company has steadily increased from 5.5 lakhs in FY20 to 6 lakhs in FY23. It's important to note that while most of our mature divisions boast a healthy PCPM, the overall company level is influenced by lower PCPM from our new divisions. However, we perceive tremendous opportunities to enhance our PCPM as these new divisions gain momentum, which will positively impact our margins going forward. Moving on to our consumer healthcare business, we achieved revenues of rupees 692 crore in FY23, demonstrating a strong year-on-year growth of 17%. Over a longer period, our CAGR has been a robust 22% in FY21 to FY23. For the quarter, I am happy to share that all our major brands in consumer healthcare have increased their market share. We are confident in sustaining strong growth in this segment going ahead. I will now hand over to Ashutosh Ji, who will provide further insights into our financials. Thank you so much.
Sure. Thanks, Sanjay. I'm joining our first quarterly earnings conference call. I hope all of you would have received our financial results as well as the press release. Let me give you a brief of the financial highlights for the performance during 12 months period ended on 31st March 23, as well as Q4 FY23 performance. So starting with the quarterly view standpoint, for Q4 FY23, revenue from operations have increased by 19% year-on-year basis to 2,053 crores. EBITDA has shown a growth of 45% year-on-year to rupees 419 crores with the margins at 20.4%. PAT was at 294 crores, representing a growth of 52% year-on-year with EPS of, which is not annualized, EPS of 7.1 per share of rupee 1 paid. For the quarter, if you look at, our gross margins are at 67.2%, which is 40 basis points lower than quarter 3, which is due to one-time write-off of close to around 15 CR on account of COVID-related inventory, which has impacted our quarterly margins by 70 basis points. In the absence of this, the same margin would have been closer to 68% for the quarter, which is at a similar rate as the pre-COVID levels. If you look at the R&D cost for the quarter, which stands at 48 CR, representing 2.3% to the sales. The total capex spend for the quarter was at 133 crores in quarter 4 FY23. Now moving on to the full year view. Revenue from operations have improved by 12% year-on-year basis, and we closed revenue at 8,749 CR. EBITDA for the year was at 1,913 CR, with margins at 21.9%. Similarly, PAT was at 1,310 crores with the margins of 15%. The annualized EPS for the year was at rupees 32 per share, having a face value of rupees 1. As seen, our reported EBITDA margins in FY23 have declined by 390 basis points, and this is largely due to three main factors. The number one is the gross margin compression. Gross margin was at 66.7 as against 68.9 in FY22. So there is a decline of 220 basis points. And this decline is coming from reasons. One is the cost impact on account of higher API prices, especially what we witnessed in H1 of FY23. That was around 130 basis points. We also did higher provisioning for COVID-related expiry products, which also impacted gross margins by 60 basis points. Lastly, there was an adverse geographical mix, which impacted 30 basis points. We have taken active measures to improve our gross margins with price increases, which has given a positive impact, especially in the H2 of FY23. The second impact of 110 basis points is coming on account of higher employee cost. This is due to the full impact of total headcount, which we added in FY22 in a phased manner. However, in FY23, there has been a full year cost impact. And this also includes the impact of new employees, which we got added because of the acquisition of Panacea. We expect this to normalize going ahead as we begin to see the productivity ramp up in the sales force in the coming year. Thirdly, there has been a one-time cost impact due to business integration of brand acquisitions during this year, which has also impacted our margins by 60 basis points. And now the other part is the depreciation and amortization expense for the year. They are at 326 crore as against 167 crores in FY22. This is on account of additional amortization of close to 140 CR in FY23 due to the amortization of the acquisition and acquisition. Our effective tax rate for full year was at 21.6% as compared to 26.4% in FY22. For the full year, our net operating working capital days were at 45 days, which is similar to what we had for FY22. If you look at the total capex spent, that was around 832 crores in 12 months FY23, and cash flow from operations were at 1,813 crores as compared to 920 crores of FY22. The company has a healthy net cash position of 1,366 CR as at 31st March 23. The ROC was 25%, return on equity was 23% for FY23 on ex-cash basis. And if we adjust it for acquisition and cash, our adjusted ROC and ROE were at 40% and 39% respectively in FY23. With this, I would like to conclude our opening remarks, and we will be happy to address any questions that you may have, please.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question comes from Prakash Agarwal with Axis Capital. Please go ahead.
Yeah, hi, good afternoon. Just one question. First of all, thank you and congratulations on this thing. Just one question. You gave an elaborate bridge of gross margin as well as EBITDA margin impact. You mentioned cost impact of API of 130 bits. How much of that, has been recovered in the second half, and what is the outlook for fiscal 24?
Okay. Yeah, thanks, Prakash, for the question. So we undertook the price increase in the Q2, and the full impact of this cost pressure has been recovered by Q4, and in the next year, FY24, so this is getting normalized. So the full impact has been covered by way of price increase.
But there is another round of price increase, if I'm not wrong, that happens in April, and the impact comes by end of quarter one. So would that be beneficial, and we would go beyond 68 is the endeavor, or how should we look about, what is the band that you're looking at the gross margin side?
Well, definitely. I mean, the NLEM price increase we will be taking from April, so that will have a positive impact on the gross margins going forward.
Okay, and any band you're looking at in terms of gross margins?
Any band?
I mean, 68 to 69?
This is in line with the IPM market price increase.
Mm-hmm. Okay. So like you said, 24 to 25% for
so basically, to answer your question, we have taken price increases in line with the NLM price increases, which have fallen in place in the month of April. So those price increases, we expect the benefits of those price increases to start coming from June onwards. So, and apart from that, whatever price increases the government allows for the non-NLM products, we have taken those price increases as well, which will happen during the course of the year, which will give effect in different quarters to come.
Yeah, so ideally speaking, the gross margin should improve from that 68% mark. Would that be correct understanding?
No, I think the gross margins would improve slightly, but not as much. Because if you see, we're sitting at about 67% of gross margins as of now, around 67.5% of gross margins. But having taken these price increases into account and, the volatile dollar-rupee conditions and the volatile API markets, we are projecting gross margins should be around in the range of 68 plus 1% or so.
Okay, perfect. This is helpful. And second question is on the cash flows. So we had a very strong cash flows. Just trying to understand, last couple of years we have taken endeavors with the gaps that we had, the Panacea and the smaller ones in respiratory and derms. What is the thought process now in terms of using the cash?
Prakash, the thought process is very, very clear that after the successful acquisition of Panacea, we're looking out for other M&As as well, and feel wherever the opportunity is right, we definitely use it. Right now, we are just accumulating the gunpowder, so that at the right time we have a good amount of money in our hands. That's a thought, because the value of any company can increase as a whole if it really utilizes the money rightly. That's the thought process. And it is always unpredictable when you get the right kind of a organization which basically fits in your company very well. Like we believe Panacea has really happened. Of course, not to forget that in 2024, we expect to incur around 600 crore rupees capex in our R&D and other places, in our factories. And as far as our R&D is concerned, it would be approximately 2.2% to our sales.
Yeah. Okay. So currently also it's around 2.3% in that range.
Okay. Understood. And lastly, if there is any dividend policy that you would like to highlight?
Basically, yes, there is a dividend policy. I mean, we are working on the dividend policy, but we don't have a fixed payout ratio as of now. We are in the process of working on the same, and will be updated in due course of time, maybe in the upcoming quarters.
Okay, lovely. Thank you and all the best.
Thank you. Our next question comes from the line of H. Kunal with Macquarie Company. Please go ahead.
Hey, hi. It's Kunal Ramesha from Macquarie, and thank you for providing the opportunity and congratulations on the good set of numbers. So while we have shared our medium-term target of growing by around 1.3 times the IPM growth, but I would like to know your thoughts on the Indian pharma market growth, let's say 3-year time period. How do you see that? Because there has been a lot of volatility with the COVID products coming in, going out, etc. But do you see, structurally, what kind of growth rate is possible in IPM? And then, based on that, what is our target growth rate that we are looking for in the next 3 years?
So, Kunal, this is Sanjay Kaul. Thanks for the question. And if you look at the IPM growth of FY23, it was 8%. After IQVIA, they have given basically next 5 years projection for growth of the IPM. So as per IQVIA, the IPM is going to grow between 10 to 11% for next 3 to 5 years. And major segments which will be the growth drivers will be cardiovascular disease, which will grow faster than the IPM growth. And the second will be antibiotics. Third will be dermatology. Fourth will be gynecology. So these are few of the segments which are going to grow faster than the IPM growth in the next 3 to 5 years as well. And these will be the growth drivers of IPM. And even anti-infectives last year grew by 9%, 6%, and the IQVIA says that even anti-infectives can grow between 8 to 9% in the coming 3 to 5 years. So we have a very strong portfolio of anti-infectives, gastrointestinal, vitamins and minerals, which are projected to grow by, the market is projected to grow by 12 to 13% as the vitamin and mineral segment is concerned. So we have strong portfolio in cardiovascular disease, anti-infectives, vitamin minerals, and gynecology. So all these segments, as per IQVIA, are going to show robust growth, and we are aligned because these segments have substantial presence in our portfolio.
Sure. So basically, it means that we should be somewhere around 12 to 14% range in the medium term annual growth rate.
So traditionally, last 5 years, last 3 years, last 10 years, we have outgrown the IPM, and even our volume growth has been higher than the volume growth of IPM, and we believe the trend will continue because we have a number of strategies in place. We are expanding our covered market. We have launched specialty divisions in the last 2 years, and these divisions are going to be the growth driver besides existing divisions. And we expect that in next 2 to 3 years, we will continue growing faster than IPM by 1.3x to 1.4x.
Perfect. And the next aspirational or kind of the range in terms of EBITDA margin, we have provided 24 to 26%. What in your view, let's say from Q4, we have ended at around 20.5%. What is the major, primary lever of that, going from 20.5 to, let's say, 25, which is midpoint? If you can provide some clarity.
Sure.
Sure. So let me give you a perspective. Hi, this is Ashutosh. So the roadmap from 22 to 25. So as we mentioned that there has been a gross margin compression of 1.3% in the FY23, which we have recovered through price increase. And let's assume that we maintain the same, even though technically what Prakash mentioned that because of price increase there are chances of improvement therein. But let's be conservative. So 1.3 recovery which we have undertaken through price increase, which we expect to continue even as a matter of abundant precaution at a 68% GC level. So 1.3 is going to come from there. 1.1% has been the drop on account of higher employee costs because we added workforce in FY22 and FY23 has been the year of consolidation. So we expect the productivity and ramp up to go up. So that should also give us the benefit of close to around 1.1%. And thirdly, there has been a one-time integration cost in FY23 because of these acquisitions. So that also impacted our P&L close to around 0.6, 0.7%. So that we expect that will normalize in the next year. So if we do a totaling of these three, we expect it to be somewhere hovering around closer to that guidance level of 24 to 26%. There are other operating levers as well as an organization level. The focus is on the chronic segment, so that also can be added impetus to the margins. So this is broadly how the roadmap from 22 to the taking it to the guidance of 24, 26% EBITDA level.
So when you say chronic, it would again be higher productivity ramp up than what we are suggesting right now, which is the current negative impact that we have seen from the. So we are just right now 1.1% is just making in break even of those new people that we have hired, right? I mean, once they start generating beyond break even.
Yeah. So that's why because and then so the impact will be on both the sides with the chronic. One is on the employee productivity and second is on the gross margins. So the impact will be double fold if we increase the chronic market share and increase it from like current 34% level to a higher levels.
Sure. And the third question that I have is on the new integrated facility, which we have said that we will kind of commercialize in H1 FY24. So is it fair to the current CWIP of 493 crore belongs to that facility? And we also talked about hydrogesterone export opportunity. So what is the overall addressable market size there? What is the competitive landscape, if you could help us understand?
See, it's very difficult to point it out because there are multiple projects which are undertaken at the organization level. Last year, we have incurred the capex, both CWIP plus the capitalized part of close to 832 crore. And this year, we are expecting it to be lower than that. That is expected to be somewhere close to around 600 crore. That's the capex spent for FY24. And this facility, which is coming up in Udaipur, we expect to get commercialized within the next 1 or 2 quarters. So there no more capex will be going on in that.
So basically, this facility which is being built in Udaipur, it will get commercialized in next quarter. And the reason for this facility is that it's a totally integrated facility where we will be producing dydrogesterone from scratch. And it will help us remove our dependence from China on the KSM. So we'll be producing the KSM, the raw material to KSM, then to the intermediate finished API, then the finished formulation at one integrated facility for this product. Because we've seen that since the last couple of years, we launched the product in 2019, ever since our volumes have been going up and we were not able to meet the increasing volume. So looking at the future volume forecast of this product, we have built this facility to cater to the Indian market and also we are exploring opportunities across the globe wherever there is market for dydrogesterone, whether it is China, whether it is Russia, whether it is Southeast Asia, South America. So we'll be exploring all the markets for dydrogesterone going forward with this facility.
Thank you. Our next question comes from the line of Surya Patra with Phillip Capital India Private Limited. Please go ahead.
Yeah, thanks for the opportunity, sir. Just first question on the, let's say, margin. You see, we have seen kind of 25% to 26% kind of margin during the COVID period. Obviously, that was a kind of a temporary opportunistic period where the margin have seen that kind of number. So now we are guiding almost that kind of scenario. So are we saying that the margin that we have on during the COVID period is a kind of achievable number, and efforts have gone towards that?
Yes, I think you are right. The margins that we achieved during the COVID period, those are achievable numbers. I mean, this year was a slightly unexpected year because last year, because of the, I mean, if you see the early half of last year, especially January, February, March, I mean, China was in a bit of a turmoil. We were not sure of how COVID situation is happening in China. And owing to the same, we started increasing the inventory of raw materials because we never knew that what's going to happen in China because different parts of China were shutting down at different times. And we started sitting on extra inventory because of that. And at the same time, the pricing of different APIs went up. So that had an impact on the first half of last year, where we were sitting on inventory, extra inventory, and sitting on inventory which was more expensive. We also wanted to take price increases, which we take during the course of the year, but there was a lag effect in those price increases because of the extra inventory sitting. So the price increase, in fact, started coming, especially during the second half of last year. So had these issues not been there, probably the margins would have been better off.
So just to complement, if you look at during the COVID period, the margins were upward of 26%, closer to 27%. So while in these guidance, so they have been tapered off, 24 to 26. So they have been normalized with the COVID effect.
Okay. So my second question is about the consumer business. So let's say over a period of, let's say, 3-year time, so what is the kind of a business share that we are expecting out of this consumer health segment? And also what is the kind of a business share that we are targeting for chronic?
Even look at the history of our consumer business, and you can draw your own conclusion. We'll continue to do quite good in that. We are right now building our brands. Rather, what we are doing, whichever brands have reached to a level, we are just increasing the portfolio range in that. In Manforce, in Dragon News, and also from OTX to OTC side we are going for. Hopefully we'll do much better than what we are doing right now.
Okay. Sir, for FY23, the margin profile or the profit profile of the consumer health compared to the reported number, could you give some sense, sir?
Actually, we don't discuss the segmental margins, but we can give you that the margins of the consumer business, they are in line with the listed consumer companies' margins. And directionally, the margins have been improving in the consumer business year-on-year basis.
Okay. My last question would be on the kind of indication that you have shared, sir, the plastic neutral, carbon neutral kind of effort over next couple of years. So whether it is going to have incremental cost or you are expecting a kind of better pricing power supporting to the profitability, how should we see this and what effort that you are really talking about in terms of cost and all that?
So we are not expecting an incremental cost because of this. I mean, whatever costs are there, I mean, a lot of these things that we are doing are based on OPEX models. And there's not enough, there's not a lot of capex going into all of this, and it is all within the rational range of expenses that we've been doing over the last few years.
Okay.
So this has a margin 68% after factoring pluses and minuses.
Okay. Sure, sir. Yeah, thank you. Wish you all the best.
Thank you. Ladies and gentlemen, a request, please restrict yourself to 2 questions per participant. We move on to our next question, which is from the line of Naushad Chaudhary with Aditya Birla Sun Life AMC. Please go ahead.
Yeah. Hi. Thanks for the opportunity. A quick follow-up on the previous question. I understand, sir, you don't share the margin on the consumer business, but broadly, qualitatively, if you can share, are we EBITDA positive here? And in terms of our marketing spend, how much we spent last year, and what is the outlook here for the next 2 to 3 years in terms of ad and marketing spend, penetration, and overall business profitability outlook?
So, thanks for the question, but I can very put it out here on record that it is an EBITDA positive business, and the operational EBITDA for this business is in high teens. And it will be very difficult to give how much is the marketing spend or the advertisement spend on this business. We don't do segmental reporting for the consumer business as such, but it's a positive business, EBITDA positive business.
And you have enough juice in terms of operating leverage here as the business grows. Should it fall? Should EBITDA expand meaningfully here in consumer business?
Yes, there is enough juice in this business to increase the operating leverage. If we see our historical margins in the consumer business, they are increasing year on year. Till about a few years back, it was a loss-making business for us, but since the last few years, the EBITDA margins have been expanding, and there is a full leverage happening because of the scale and size of the business at which it is growing.
Right. And lastly, in terms of the API cost pressure, so are we? Do we still have high cost inventory, or is it over in this quarter, and from next quarter onwards, there shouldn't be?
I would say most of the high cost inventory is gone now. We'll start reaping the benefits from next quarter onwards.
All right. Thank you so
much. Some of these benefits have already started coming in.
Yeah. And the inventory, number of days of inventory has also come down in the system.
Right. Yeah, thank you so much, sir. Thank you so much.
Thank you. Our next question comes from Harsh Bhatia with Bandhan Mutual Fund. Please go ahead.
Yeah, thank you. Good afternoon. Just 2 quick questions from my side. In terms of your opening comments,
loud.
Yeah. Is it better now?
Yeah.
Just in terms of your opening commentary, you mentioned that you had a 2.5% volume growth versus IPM being flat. So if you could help us understand in which therapies did you have this sort of delta? Like, is it entirely infectives driven where you had 2.5% incremental volume growth against the market, or is it more to do with the chronic market side? So that is basically to understand where have we gained market share in which therapy on volume basis.
So this is Sanjay call. So it has been, if you look at the volume growth as well as overall growth in FY23, so we have seen higher growth in chronic segment as compared to the acute segment. Our chronic has grown by 1.3x compared to the IPM growth. So chronic has definitely shown a better growth as compared to the IPM growth, and it is 14% versus 9% of acute growth. So volume growth definitely has come from both chronic as well as acute, but higher growth is coming from, of course, the chronic side.
Okay, fair enough. And in terms of the chronic share that you are highlighting at 34% versus 33% last year, this includes the 34% includes the Panacea acquisition as well. Is that the fair understanding?
Yes, it is including both, but let me add here, if you remove, see our growth is, overall growth is 11%. If you remove chronic, if you remove Panacea from equation this year and from last year, so our growth improves to 15% instead of 11%. So Panacea will start basically producing good results in this financial year, that is FY24, and the first 6 months We try to basically rationalize the tail. We try to basically correct the things in Panacea, and we are aligned because our Q4 growth in Panacea business was 19%.
Okay, so just to clarify, the Panacea numbers are there in FY22 and FY23 as well. So could you quantify those numbers, if possible?
So these are IQVIA numbers, and we have shown growth in this year. That is, FY23 has shown a growth over FY22. This is as per IQVIA. And even the top 5 brands of Panacea have shown a growth of 6%.
Just to put perspective, if you look at the what Dr. Kaul is mentioning is that if you look at the IQVIA numbers, the numbers for last year and this year for both include Panacea. So if you knock them off, then the growth for the company is around 11%.
Correct. Chronic is 15%.
And chronic is 15%.
Okay, all right. Thank you. All the best.
Thank you. Our next question comes from the line of Mitesh Shah with Nirmal Bang Securities. Please go ahead.
Thanks for taking my question. Congratulations for the strong listing and the results as well. My first question is regarding the gross margins. If you can see in the first half, definitely, as you said, would be under pressure. But the second half gross margin has improved by around 127 bits. I'm just comparing one half versus the second half. Now I'm just looking the operating margins, EBITDA margins, that have declined. In first half had a 22.9%, 23%, in the second half declined to 21%. I can understand that 4Q might be a soft, but 3Q also have a 21% of margins, and we are guiding around 24 to 26% of margins. So I'm not able to understand that gross margin already improved in the second half, despite that the margin haven't improved. And also in a 9 month, if I can see from your bifurcation, then in a 9 month versus 9 months of last year, marketing spend has reduced by around 125 bits. That also have benefited the EBITDA margins of 9 months of FY23. So that what I'm missing, I just want to understand that how would you able to see that, because I'm expecting the margins, marketing spend will be normalizing next year as well.
Sure. So just to put it into perspective, if you see the sales mix over the whole year, so if you compare H1 to H2, so H1 sales is approximately somewhere around 52 to 53% of the whole year sales. And the H2 is normally 47-48%. So one is because of the lower sales and the fixed expense base is pretty constant. So there is a direct hit on the margins. That is point number one. So if you see H1 margins are fairly stronger as compared to H2 margin. So that's one of the reasons why it has been. Secondly, the gross margin, if you see the H1 gross margins, they were quite compressed, close to around 66% level, which we have recovered in the H2 part of the year. So basically, the margin erosion is coming because of the lower sales.
Got it. So you mean to say that generally the 1H would be a stronger for you?
Yes, that has been the historical trend has been. Then accordingly, the sales and marketing expenditure is also linked to the sales. So that's why you see there is a drop in the sales and marketing in H2 as compared to H1.
Actually, I'm talking about 9 months, because in your RHP, the 9 month comparison has given, and it has reduced around 125 bits.
And if you see, I mean, historically also, if you see that quarter 4 margins are generally lower for us. I mean, if you see the past few years also in Mankind, the quarter 4 margins are generally lower for us.
I think that could be the reason, because the domestic sales are mostly a soft, but this quarter I haven't seen any softness. 3Q to 4Q are almost similar. So that's why even I'm surprised at the subdued margins.
If you will see the margin Q3 and Q4 sale has been 2% lower as compared to Q3 sale. And that's why there is a slight drop in the margins between Q4 and Q3.
And can you just I got the margin point, and now just looking the exports are growing robust, around 65% growth in the 4Q and 58%. So what is the outlook and how do you look at the export? Definitely it's a smaller pie for you.
This side. So exports growth is looking higher because the base last year was very less. And going forward, it's an Indian-centric company, and Mankind's focus will always remain on India. So always 96 to 97% of our revenue will come from India. The focus will be on India.
Thanks. That's it from me. Hello. Hello.
Yes, please, sir.
Can I squeeze one more question on the tax rate? Can you just guide about the tax rate for next year, next 2 years?
Okay. So if you see the effective tax rate for current year has been around 22%. And before that it was 26%. And the drop in the effective tax rate is primarily because we have increased our Sikkim facility where we are availing exemptions. And then secondly, because of the acquisition, higher amortization cost has also given us a depreciation benefit. And with regard to the future guidance part, we expect the tax rates to be somewhere closer to 22 to 23% level. Why we are saying so? Because we have multiple manufacturing entities, so they are at the effective tax rate. So we expect tax rates to be in the range of close to 22-23%.
Got it. Good. Thanks for all the answers. That's it from me.
Thank you. Ladies and gentlemen, a reminder, if you wish to ask a question, please press star and 1. Our next question comes from the line of Kunal Dhamesha with Macquarie Company. Please go ahead.
Yeah, thanks for the opportunity again. So a couple of questions. One basically on the field force productivity number that we have shared. So is it calculated on just the MR numbers and not including the first line manager? Is the way to look at it?
So it is on the basis of medical reps only, not managers.
Okay, and any particular reason why would you, not add any business reasons in a way, that they are just a managerial role or even they, kind of contribute to say?
So this is the normal practice in the industry that PCPM is basically calculated on the basis of the medical reps rather than including managers.
So if the managers gets added, so it will be double accounting because managers are controlling 8 to 16 depending on the span of control. So that's why it has been calculated at the MR level.
Okay. Perfect. And secondly, on the specialist coverage, since we have launched, I think, 18 division around 2 to 3 years back, focusing on chronic, what kind of specialist coverage progress that we would have made in the last 3 years? Any metrics would be helpful for us to kind of track.
So our coverage among the specialists is our overall coverage among the doctors is 82%. When I talk about specialists, one of the major specialists comes is CP, that is consulting physicians, which is approximately 35 to 40,000 in the IPM in the industry. So our coverage of and prescriber share of CPs is 93%. It is one of the highest in the IPM. So besides family physicians, where our prescriber share is 91%, our prescriber share among the CPs
who are considered as specialists is 93%. So post launching of these specialty divisions, we have made inroads in the chamber of specialists like CPs, and we have also improved our prescriber share among endocrinologists, diabetologists, and cardiologists.
And so super specialist, any number?
That's what I'm saying. When I talk about the diabetologists, our prescriber share is 84%. Cardiologists, it is 87%. It is among the highest in the IPM.
And when you talk about the super specialty side, I mean, we have given the example of Neptaz. It is hardcore super specialty license product got from Novartis. In that, it is explained that we were the second best launches of the year. Mankind on one side is famous for selling affordable prices, but over there, when we went in this super specialty category, we had no advantage of prices. It was sheer on the basis of merits of the quality of working. Mankind could really put in those super specialty doctors.
Sure, sir. And the last one is basically on the capex. We have said 600 crore. Out of how much that would be the maintenance capex for us?
How much is the maintenance capex? So normally, what the thumb rule what we follow is close to around 85% is the growth capex, and 10 to 15% is the maintenance capex.
So, sir, when I look at our gross fixed asset turnover, which is roughly on the FY22 base of, gross block, it's somewhere around 3.6 times. And if I compare it with some of the, domestic focus name, it is meaningfully below that number. And if I look at the capacity utilization across our plant is also meaningfully below, like formulation would be close to 40%, API would be close to 40%. So my question is, while the current capacities remain underutilized, what is driving the, de novo capex in terms of capacity expansion?
So if you look at our range of products, it's a very diverse range of products spread across antibiotics. Then antibiotics, we have cephalosporins and beta-lactams. We have hormonal products. We have general category products. We have soft gelatin. We have nutraceutical products. We have ointments, syrups. So all of these different therapeutic products, they require different set of facilities, right? And if you compare us to others, most of our peers, generally what they do is they outsource their domestic manufacturing to contract manufacturers. And generally they in-house those manufacturing facilities where they're producing for the regulated markets or export markets. We manufacture about 75% of our products in-house. So that gives us a couple of benefits, both in terms of quality as well as in terms of delivery timelines and supply chain controls. And more than that, the margins that these companies give to the contract manufacturers, we retain those margins in-house, which help us increase our gross margins, even though the pricing of certain of our acute side of products is much lower or much competitive than the market. The reason why some of our facilities are lower in terms of capacity is because we made a huge expansion in our Sikkim plant, which is reaping the tax benefits. And in years to come, these facilities would be utilizing these capacities very well.
Sure, perfect. Thank you.
Thank you. Our next question comes from the line of Rahul Jivani with IIFL Institutional Equities. Please go ahead.
Hi, sir. Thanks for giving me the opportunity. Sir, can you comment on a bit more on your Panacea portfolio? And specifically, if I look at the growth for the top 5 brands of Panacea, that looks muted at around 6% for FY23. So any reasons why top brands of Panacea have grown slower this year?
Rahul, thank you for the question. So first of all, you're supposed to understand whenever we have always seen any acquisition, we've always seen from the point of view of long-term strategy. One was that Panacea was offering us better gross margins. Second was most of the products were chronic side. And third was they were quite niche. And one more factor should not be forgotten. We got a patented product. I mean, how many patented products could be there in India? Very few. You can count on your fingertips. Keeping those things in mind, Panacea was acquired, number one. The number second big thing was, when you take some company which was being run not very nicely, it takes time to really integrate the whole organization. So first year always be like this, and can be like this only because it takes time for the people to understand, we to understand those guys. We took this company inside Mankind in March of 22. So it's just 12 months. Just wait for a few more months, wait for the next this same call. You'll find us doing fantastic.
Sure, sir. So the growth which you saw on this portfolio during the fourth quarter, which is at around 19%, do you think that we can continue this sort of a growth trajectory on the acquired portfolio over the next, let's say, a 3 to 5 year period?
Why not better?
Sure.
Why not better? That's my answer.
Sure. And sir,
see that because keeping that in mind, we have gone for this company.
Sure. Okay. And sir, the next question which I had was on your PCPM. That given that we have added almost 8 to 10 new divisions for the domestic market over the past 2 to 3 year period, can you split out your PCPM of 6 lakh rupees between the legacy business and the new business so that we get some clarity in terms of what kind of a PCPM improvement we can see in some of these newer divisions which we have added?
I can tell you roughly, our established old divisions, traditional companies have a PCPM of 9 lakh, 10 lakh, 11 lakh, 12 lakh. And last 4 years' time, whatever new specialty divisions we have launched, and don't forget, out of these 4 years, 2 years were lost in COVID time, starting, closing. So you can say they are around 2 years old, right? The PCPM varies from 2 lakh rupees to 3.5 and 4 lakh rupees. That's what about PCPM is there. But yes, they are growing faster because of lower base. That's the point over there.
And this 3 to 4 lakh rupees of PCPM on these newer businesses, where do you see this number trending to in, let's say, the next 3 years?
I cannot really comment on that, but I can tell you, we wish these companies to grow, substantially well, very, very good. They should be good drivers in future. Without giving numbers, they will drive our growth. And on what basis we are saying that our chronic share will increase? On what basis we are saying that our gross margins will improve? Naturally, chronic side. Naturally, these companies, these new divisions.
Sure, sir. And do we have any further rep addition plans for, let's say, the next 1 to 2 year period, or are we sufficient with the rep team which now we have created over the past few years?
Plenty has been done, substantial has been done. 5-7% I cannot rule out. That would be on the basis of requirements.
Sure, sir. That's it from my side. Thank you for answering my questions.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question. I would now like to hand the conference over to the management for closing comments.
Thank you everyone for joining us for the call. We really appreciate you taking time for our first earnings call. We look forward to interacting with you going ahead in subsequent quarters as well. Thank you.
Thank you.
Thank you very much. Thanks everyone. Thank you.
On behalf of Kotak Institutional Equities, that concludes this conference. Thank you for joining us, and you may now disconnect your line.